Hello and welcome to the first video about the Hedge Pressure Index study. A study which I created quite a long time ago, about 2 years, maybe even more. And a study which I never published before. The reason why I have never published it is that it didn't work as I imagined it should work. And the strange thing about it is that the model itself, theoretically, was pretty reasonable, pretty logical. And after plugging the numbers in, it just produced a bunch of random things. At first sight, at least, it was quite random. And so I moved into more of things like call and put walls, levels where there should be a concentration of dealers' activity. So basically more on the prices rather than the impact of hedging or dynamic hedging itself, which would be probably more something like sentiment or a pressure indicator. So the basic promise of such studies is that because we have such a huge volumes traded on the options, then it definitely impacts the prices of the underlying assets, like let's say index options, which we are dealing with most of the time here. So basically, when there is a transaction going on in the options market, right, then the dealer has to hedge these transactions, as usually they are, like 99% of time, they are the other side of the transactions, right? So if somebody buys calls, for example, for SPX index option, then the seller of these options is usually a dealer. So that's the basic modus operandi of the options market and the dealers. Now, the thing that interests everyone who dives deeper into analyzing options data and futures data is that if, let's say, there is a rather large transaction from a trader coming into options market, let's say it's I don't know, like 1,000 lots, right? So the dealer has to sell this 1,000 contracts, and they theoretically go to the futures market, right? And they hedge themselves by buying the futures. And this operation makes what, in very basic description, makes what the dynamic hedging is. Now, all the concept is, what if that transaction on options, this 1K, maybe 10K, on many different levels of strikes, of expirations, are coming into the options markets, then the dealers are hedging these transactions on futures markets. And what they also have to do, they have to update their models to know basically how much they need to hedge. And these things that we call Greeks, for example, have to be updated. Sometimes it happens before there is any movement or any sign of this movement in futures market. So basically, if somebody buys a lot of options, the prices of the option goes up. But it doesn't necessarily mean that the future prices is going to go up. It can stay flat, or it can even go a bit lower, right? Even though the prices go higher. And if the prices of the option go higher, then we have many different ways to measure that disproportional divergence. Okay? And this is what we are looking for with these models, where we are trying to gauge if there is some discrepancy between the options and the futures, and taking into account the hedging, dynamic hedging operation by the dealers. So this is basically what the hedge index or hedge pressure index is trying to gauge. Okay, so that is the basic description of what it is. But the key thing here is that there are hundreds of ways to do it, hundreds of different calculations. And back to where I started with this model, so 2 or 3 years ago, my way of thinking, I thought, is the most logical, at least for me. But again, when I, plugged in the numbers, it didn't really work out. So what happened here? Why am I back at this model? And why I'm about to publish the study? Well, as crazy as it sounds, the reason why my model didn't work was something really trivial, but in a way not so trivial. It's about the data. So for some people who are into the options data, so not only the prices but the Greeks, implied volatility, and so on, well, we use chunks of this data. We don't use usually all of this. And for some usages, it's really okay to use things like retail data feeds, which you can find on your platforms like Thinkorswim, for example, right? They have a really great and easy way to connect you with Excel or with Python, and it's really easy to do some kind of operations and calculations on live options data. The problem is that if we are talking about volumes, open interest, and some basic Greeks, there is usually not really a problem. But with my model, it appears that the data makes a whole world of difference. And recently, I was able, or had the opportunity, to plug into this model, and not only into this model, but to test out professional options data feed. Well, and I have to say that on one hand, I'm really happy because I finally found the reason for many different things that I do, a solution for some problems. But on the other hand, I know that a lot of the things that I'm already doing has some pretty major error in it. The only problem with this data at this point is that, first of all, it's expensive. Like, it's the most expensive data I have ever used. And we'll talk about it later a bit, but this is also why, the price of the study. But yeah, let's go into my work so far with the model and with professional data. Okay, so the study, the first original study, is very simple, right? It looks like RSI or whatever, it's basically around minus 200 to 200 of value. Probably sometimes it will have a bit more or less on a total scale. I try to update it every minute, and it is 24 hours, but it really starts to matter as other of my tools, and which is quite logical. It starts to matter about London Open, right? And then until last hour of trading is a bit less reliable on the options, where the option effects just fade a bit more. So this is just one line, the Hedge Pressure Index. And the basic promise is that if the dealer's influence is negative, then the prices should be dropping. If it's positive, so it's above zero, it should impact the underlying asset positively, and making this loop of buying pressure. So that is the initial thought, and this is something that I tested as a first thing, to see if there is some logic to it, if there is some cause and effect relationship. So we'll go through last few days without cherry picking. These are last few sessions straight, one after another. So we started February 7th, and basically we have two charts, the bigger ones. So this is the ES futures March contract. This is the Hedge Pressure Index, and it's colored in a way that if it's above the zero, then it's green. If it's below zero, it's red, and so on. And here is the raw P&L. That means that it buys when the index is above and sells ES futures when it's below. So this is just one day, right? So it starts at about London Open, and it ends at New York close. So it's a few hours of trading, and I would just wanted to show you this initial straightforward understanding of this study, and also it will show you how it acts in different conditions, right? So we have a rather bearish day on the 7th of February, where the bulls tried to break out to the upside. But as you can see here, right, it was basically whole way down. It was indicating that the pressure from the hedgers or from the dealers is to the downside. And the P&L looks like this, right? So the beginning of the US session is somewhere here. It's rather important because what I've noticed is that after the US opens, it is even more significant to look at what's going on here. Okay, so let's go to next day. So that was Friday, so the next day is Monday, February 10, and you can see that it is almost whole day, it is bullish. And even with this very basic approach, our P&L is nicely positive. So basically the February 7 was about plus 50 points. Then we have February 10 just trading long short, depending on if the indicator is above or below. It made like 25 points, and it was actually the whole range of that day. Then we have February 11, and again we have rather bullish day and also bullish hedge pressure for majority of the time, and the P&L is about, again, 25 points. If we would start trading at the US Open, it would be somewhere here. The next day is the CPI, when the market really dropped hard on the news, but then it just regained its bullish stance, and you can see that the Hedge Pressure Index was bullish almost all the session, right? And it basically cut that move down on the wrong side, but then it kept the position, and it basically ended up break even. Again, this is just a basic approach to this. In the next step, I will show you the strategy that I made, or some more precise indications based on that Hedge Pressure Index. But let's go through this very naive and simple approach. Okay, let's go to February 13th, where it basically market goes up. It's up for the Hedge Pressure Index is up for the majority of the session, and the P&L is above 50 points. Again, nice run up with the market. And then we have last Friday, and this one is interesting because you can see that it has a lot of short trading and buying short, etc. And the P&L for this is still positive, and again it's about 25 points. So it's pretty constant when the market is range bound. It's pretty constant where there is a trend, and it doesn't have a bias for a bullish bias, as we can see here. So this is very good, because a lot of times when people model these things, they have this internal skew of the market to the put side, whatever, if the model treats it as bullish or bearish, well, it will have more bullish impacts than bearish. And in some major bearish moves, well, it can be really tricky and dangerous. So basically, all these days which I have shown you are, first of all, these are positive days. These are different kinds of day. Like here, it's a bullish day, but with some major pullbacks. And as you can see, they are not visible on the hedge pressure index. So this is also important, that this is not following price. This, if it is related to price of underlying index, it is not linear. It is it looks like a leading indicator, and that's what we want to see. Now, one thing I've noticed so far is, as you can see here, this is colored in a bit different way, because it's colored, for example, red, even though it's above a zero line. That's because there is this simple formatting here. It colors red, so bearish, until the last extreme happened below or at minus 100, and it will print red until, so bearish impact, until there is an important strike on the bullish side. So the index has to go at least to 100 or more. When it does, it will start to print this green bullish impact. And then it changes again to red because it just fell to minus 100, right? And it will stay red even though it sometimes went above zero line. Well, this will, that was my intention, prevents maybe some whipsaws. And historically, it looks like this is what actually happens, that for the impact to change the direction, it has to be strong push to one or the other side, so plus 100 or minus 100. So now I will go through the same days, but with this thing in mind. So here you can see that we have the same charts, but the hedge pressure index is colored in this way I explained. So we are at 7th February again, and one new thing you can see here are these squares, green, red, and also these black little lines here. What these are basically the very simple logic. So the logic is that we wait for a trend. So let's say in this instance here, we are in a bullish trend, and we wait until the HPI index gets back to close to the zero line. And when it does, it just prints the green triangle, right? Then when it gets back to 100, it will print this minus, black little minus here, to exit the trade. Or if it falls deep, below minus 100, the trend is changed, and when it gets back to 0, it will print the red signal, so a bullish signal and bearish signals. And if the minus is below the SPX or S&P futures plot, it means it's exit signal for a short. When it's above, it's exit signal for longs. So quite a simple approach. You can see a few examples of this. We got back to 0 from minus 100, and we have these squares here and here, the same situation, right? And these are the exits from these shorts, right? And this is the last 30 minutes of trading, which is not so important, but still it prints signals there because I was just testing this. So we can see that these are basically the signals, right? Intraday trading signals. So this is not as trivial as before, which we have here. This is the trivial P&L, a raw P&L based on the same thing I showed you before. And these are actually the signals of trades. Well, potentially, because that's my initial idea on how to use it, right? So we have long, short, exit, and short, and exit, and short, and exit, and short, and exit, right? So these are the trades: long, short, short. It looks really, really nice. So let's see the rest of the days, right? So now we are at the day number February 10. So these are just entry here to exits, maybe enter here more and exit, and then a lot of bullish entries here. And the whole day was green, right? Because it never got to minus 100. So the impact, looking at it in this way, the impact was bullish whole day. So let's go to the next day. So this one is February 11th, and we have the same situation. So the whole day, the impact is bullish. So we have like here. That's before the US session starts, right? It's London Open. And then here to the end of the session. So there are only bullish signals here throughout the whole session, right? Let's go to the CPI day. CPI is interesting because it shows that the whole session is again a bullish pressure, because we never got, the hedge pressure index never got to minus 100. But the interesting thing is we had a long and exit before the data, right? Because this is exit for long, and then entry at the bottom and to the end of the session. So that these are a really nicely traded CPI data. Okay, then we have which one? This CPI. So now we have 13th. So again, we have a bullish pressure, and we have entry and exit, a quick one here, and then entry until the end of the session, right? The reason why there is no exit from these is because, as you can see, the hedge pressure index never got to plus 100. So it went long here, here, and here, and here, but it never got to 100, which is the exit for longs, right? And the last day we have in this presentation is the interesting one, because a lot is going on here. But let's see, these trades are, there was no exit from these shorts until there was a reverse, right? The green signal here. So all these were short, and then there is a reversal because of this, right? And we go up until the next reversal, because this is the exit for shorts, but we are in the long. That's, I probably will, in the final version, it won't print bearish exits when we are in a bullish position, but hope you understand what's going on here. So here we have a short reverse, so this is short here, then long here, the reverse exit, and then we have re-enter short, and that would be probably a loss, because this is exit from the short, right? Short again here, and then there is the short and exit here, something like this. So this was a bit more tricky day. A raw P&L shows that it made money. With this approach, it would definitely make also money, but it was a bit more tricky in handling these situations. But again, if you look at that chart, like the thing I've described to you is a candidate for automatic strategy, right? Because it has entries, exits, reversals, and stuff like this. And it would probably need some kind of stop loss, like a hard stop. But yeah, this is bearish, this is bullish, right? And this all is bearish here, right? So it's pretty obvious, right? We don't have anything, in between. I don't know if these exits are the right strategy, but this is what I've noticed so far. Okay, so without cherry picking, that's how it looked last few sessions, which were different types of days. So how does it look like in the terminal? So this is the last session. I will publish it or deploy that tool tonight, so it will be available tomorrow for a trading session. I will probably do some minor changes at the beginning, but the goal is I want to build a tool which is going to analyze all the major instruments, not just the SPX, in this way with Hedge Pressure Index. This one is for SPX, ES futures, but I want, because I have access to everything now, I want to use it and build around it a lot of things. So here you can see that everything I showed you on the chart, on that last chart, is now available in a terminal on emini.today website. So the signals, the short signals, the buy signals, colored in a way, as I explained. If it's plus 100, it starts to color it green until it gets to minus 100 and then starts to color red. The blue triangle up is exit from short. So right now this one doesn't make any sense because we are in bullish position, right? But it will also print exits for bullish positions if there are any. So it's very simple to read. Now I will this week probably I will hook it up to Discord, and it will alert you when the signal comes in, when the HPI index changes sides. So you don't have to just rely on the chart. You will have a few of these conditions alerted through the Discord. And the third part is I want to build initially two bots around this. So definitely one with trades like that, and the other with just trades raw P&L. So if the HPI is above, then buys. If it's below zero, then sells, because the P&Ls look too good. I want to try this. It's so all the users who will have access to this one will have all the other things like Discord alerts, more instruments when I will add them in very near future. Maybe in 2-3 weeks there should be much more, including some major stocks, probably Magnificent 7 or something like that, QQQ, so the Nasdaq ETF options, and the bots. The bots initially for Ninja Trader, but also for Sierra Chart. That's the plan. I also want to change completely the way I archive things. So all these days and data will be archived in a way that it will be accessible for a user. So you will be able to go back to some session, historical session, and see how it performed. The only problem is I started to use this data feed not long ago. I'm gathering as much data as I can, but I also have to gather the ones that I really need, because it's so much data that I really need to be picky to make sense out of it, because it has to be done this way, because I would run out of space like after a few days. So yeah, you can go to imini.today, and I made a special offer for accessing this. I know it's not like a cheap one, but then again, I've noticed recently that I don't know, things like OFL studies, some option analytics, they all actually cost like $200 a month, around that price. And none of them, in my opinion, as far as I was researching it, none of them is like as automatic as this one. If you want to make a bot for many of these, then you're not going to make it. Like, I don't think you can make it. I don't know. Maybe there are some indicators which I didn't see, or analysis that I didn't see, but honestly, like, this is the highest level of confronting the reality, in my opinion. Like, if you have a study and you say that, okay, it's a helpful study, yeah, but usually it has to be used with something else, then for me it is like saying, like, well, it's not working as a standalone, right? this thing works, so far it works as a standalone. And I assume this is not a holy grail, right? So as every study or as every tool, it has to have some money management and blah, blah, blah. Yeah. But I don't know. For now, it looks perfect for me. Now, when you buy access to this, you are helping, pay for the data, right? And this is the only way I think that people can get access to these things actually with some reasonable pricing. And these are definitely things that some professionals have. I mean, probably not exactly this study, but some things like these. And of course, you get also access to my other tools. So the whole terminal. Yeah, so you can have like side by side these two. So we have like a bearish signal here, right? And there are the levels, right? But this is different, right? This sentiment study is totally different than anything I've showed before. Well, now we know why, but you get the ET terminal. You have I made a promotion like 1 month free if you get quarter, so 3 months access, and even more promotion if you go for a yearly. And yeah, I hope you enjoyed it, and I hope this is gonna pay off, and it will work like it's working so far. So see you on the other side. Cheers.